Hello everyone and welcome to this next quick fire revision video for Ind AS 20 government grants. Now this is a tier 2 category standard and can come in the exams on its own as well as clubbed with other standards like PP as well as financial instruments. So the basics of the standard: first, what is a government? Can include the local authorities, can include the state, central as well as international bodies can be included as a part of government. Then what does the standard cover? Well, it covers government grants which are basically quantifiable in monetary value terms like subsidies for example, or even government assistance which can be something like a free technical assistance or a logistic support, let us say, which may not be in a position to be quantifiable in monetary value terms. So if a grant which is quantifiable can be shown in the books of accounts, well, it can be accounted. You can actually account for this government grant. On the other hand, disclosure is something which is not quantifiable, in which case the standard says you just give a disclosure for something which is in the form of an assistance. Now, a large part of the standard focuses on the grants because accounting is to be done, whereas assistance is merely disclosed. So when should you initially recognize a grant? Well, grant should be initially recognized the moment it becomes receivable. That is, the application criteria, etc. If you have to make some application, seek some approvals, the moment they have been fulfilled, that means you can recognize a grant, it becomes receivable. You do not need to wait till the time the grant is actually received in your account. Secondly, the conditions that are attached to the grant are expected or likely to be fulfilled. You don't need to wait till the actual completion of those conditions. So this is the initial recognition of the government grants. And to what does it apply? Well, to all government grants, except there is some small scope exclusion where this standard is not applicable. That is, if there is an investment done by the government, like an equity investment, that is not a grant, it is an investment with the hope of a return. Loans which are given by the government generally at the market rates of interest are not covered by this standard. Income tax deductions or exemptions are not covered by the standards, and government grants which are linked to biological assets are not covered because there is a separate standard, Ind AS 41, which deals with the same. So that is regarding the non-applicability of Ind AS 20. Next, what are the types of government grants? Well, there are two types of government grants. There's grants linked to assets and then there is grants linked to income. Grants linked to assets have been defined as grants which are specifically for the acquisition, construction of a particular asset. On the other hand, grants linked to income have been beautifully defined as grants which are other than grants linked to assets, which means every other grant. You don't need to actually show that it is linked to earning income or incurring an expense. Every other grant, like a lump sum grant, for example, which is given to encourage you to set up in a backward region, is not linked to the acquisition of a particular asset, and hence that can by default go into the grant linked to income. So grants linked to income will be defined as every grant which is other than a grant linked to asset. So first we'll try to understand the accounting for a grant linked to asset. So if it's a grant which is linked to the acquisition of an asset, which can be either a monetary grant or a non-monetary grant, like there may be an asset worth 300 rupees where the government gives you a grant of 200 rupees in the form of a reimbursement. So you buy an asset worth 300 and government gives you a 200 reimbursement. That is a grant in money value terms. So that is a monetary grant. On the other hand, if the government directly gives you the asset worth 300 at a concession price of 100, this is like a non-monetary grant. The accounting for monetary or non-monetary grant ultimately remains the same. So what are the choices which are available? The choices which are available is, if it is a grant linked to asset, let us say the grant is worth 200 rupees and the asset is worth 300 rupees, then you can either reduce the grant from the asset, that is show the asset at a net 100 amount and then depreciate it, that 100 over the remaining life, or you can show the asset at the full 300 amount and then show the 200 as a deferred grant. Then the depreciation will be based on the 300. Let us say the useful life is 10 years and the depreciation will be 300 divided by 10, that is 30. And likewise, the deferred grant will be amortized in the ratio of depreciation, that is 200 divided by 10 will be amortized in the ratio of depreciation. So the deferred grant account will go from 200 to 180, then to 160, then to 140, and then so on. It will be amortized to the profit and loss over the life of the asset. Now, this is the general principle that you need to follow. However, there are some special cases for which you need some additional guidance. Like if the grant is for a non-depreciable asset, like land for example, then there is no separate ratio of depreciation, in which case you will have to take some other appropriate ratio, like the ratio in which expenses are likely to be incurred or the project life as a case may be, because the deferred grant has to be amortized. It cannot be kept into deferred grant or shown into some capital reserve. It has to be amortized. Second, a special case can arise, especially in case assets are obtained free of cost, especially if it is a non-monetary grant where the asset is given fully free of cost, in which case you are not paying anything and hence there is no separate entry that is recorded, especially if you are showing the asset net of the grant amount, in which case the standard says you can show this asset at nominal value. Nominal value is value for namesake, just nominal, maybe 1 rupee, maybe 10 rupees, maybe 100 rupees, depending on the size of the company. You can just show it for namesake. That is a nominal value. Assets which are shown at nominal value are just for namesake, and you don't need to separately depreciate those assets in any way. So over here, we have given this first case where we are discussing about assets received free of cost. A second case over here will be in case of items like land. Again, in the exam, if nothing's given, you can either show the asset net or you can show gross. Either of this, you write an assumption and you can solve. Now, there may be a problem in case of an asset which is under construction. So, if an asset is under construction and the grant is received upfront, you may not be in a position to net this off from the asset, because it might be that the asset is being constructed and the government has given you grant. If you decide to net it off, it might even show a negative balance, and hence the standard over here says that if a grant is given for an under construction asset, you can put it into the deferred grant account till the time the construction is completed, after which if you want to reduce this from the cost of the asset, then before you start depreciating, you reduce this grant from the cost of the asset and then you depreciate the net amount. Or if you want to continue to amortize it in the ratio of depreciation, depreciation can only start once the asset is ready for use, in which case you will depreciate after the asset is ready for use. If there is an unconditional grant which is given for a fixed asset, so there is no conditions attached, the standard still applies the same treatment. Like when you will study further, you will see that in income linked grants, if it is unconditional, that is non-refundable, then the entire balance will be taken directly to the profit and loss account. However, in case of an asset linked grant, if it is an unconditional grant, you will still continue to account it in a similar way. Like you can either reduce the grant from the asset, show it at net amount and then depreciate, or you can show it as a deferred grant and amortize it in the ratio of depreciation. So this is about the accounting for grants linked to assets. Next, you go to the accounting for grants linked to income. That is, every other grant other than a grant linked to asset is a grant linked to income. In which case, if it is an unconditional grant, that is, it's a non-refundable grant, no conditions are attached, or if it is a grant which is linked to past losses that have been incurred by the entity, then the grant will directly be taken to the profit and loss account. On the other hand, if it is a grant linked to future expenses like training expenses that you have to incur, then you will amortize this grant in the ratio of the expenses that are expected to be incurred, and if there is no clear ratio available, then in the ratio of the time over which these expenses are going to be incurred. So, if this grant is linked to some future benefits or future expenses, then you will initially record it in the deferred grant and then amortize it in the ratio of the expected expenses or in the ratio of time as appropriate. If it is an unconditional grant or a grant linked to past losses, you will take that into the profit and loss account immediately. A summary of the amortization principles have been given over here, where we say that if it is grants linked to assets which are depreciable assets, and if there is a deferred grant balance, you amortize it in the ratio of depreciation. However, if it is a non-depreciable asset, then you select an appropriate ratio over which you will amortize. You can't show it into a capital reserve or keep it into deferred grant. On the other hand, if it is income linked grants which are linked to future expenses or benefits, you will amortize it in the ratio of those expenses or the ratio of time, whichever is more appropriate and relevant. A few special cases are discussed, like forgivable loans. Forgivable loans are like loan waivers which sometimes the government gives, typically sometimes before elections. So these are also not linked to acquisition of a specific asset. These are just general, in most cases unconditional waivers given, let's say, to farmers sometimes, in which case your entry will be loan account debit to, well, if it is unconditional, no further expense have to be specified, then to P&L account. Next special case is if there is a lump sum grant which in your CA Inter AS12 was called as grant in the nature of promoter's contribution, which is not linked to the acquisition of a particular asset or not linked to incurring of a specific expense or income. In which case, if you have received a grant for setting up, let us say, a factory or setting up a business in a backward region, in which case that is a lump sum grant which is given in the nature of promoter's contribution. If it is not linked to the acquisition of a particular asset, then we treat it as a grant linked to income, and hence if it is unconditional, you can take it to the P&L immediately, or if it is subject to satisfaction of certain future expenses or conditions, in which case you can put it into deferred grant and then defer it. The same principles apply. A special case which is given in the institute study material is linked to something called as EPCG, that is the Export Promotion Capital Goods scheme, which is there in customs, where what happens is the custom duty that you pay can be drawn back if certain specified export targets are met. So the primary objective, as per a specific guidance given by the Expert Advisory Committee of the ICI, is that the primary objective of the EPCG scheme is to encourage exports and not necessarily make the capital good that is imported cheaper. It is to encourage exports, and hence, if it is an EPCG scheme, unless it is specifically given otherwise, we will treat it to be a grant linked to income. So if it's a 100 crore asset on which 50 crore of duty is paid, on which you are going to get a drawback, provided you export for the next 5 years specific quantities, in which case you will treat this 50 crores, let us say, as a grant because it is quantifiable, and then amortize or defer it in the ratio of exports or benefits that are going to be incurred. So you treat it as a grant linked to income and not grant linked to asset, because the primary objective is encouragement of exports. The most important thing, in my opinion, in this chapter is the loans given at concessional rate. Now this is a case where you have a very strong interlinkage with Ind AS 109 financial instruments. So loan, remember, is a financial liability. If you have taken a loan, it is a financial liability, and Ind AS 109 says that initial recognition financial liability should be shown at fair value. So for example, for simplicity, let us say it is a 5-year loan which the government gives you interest free, in which case the market rate of interest on similar loans is, let us say, 10%, and hence Ind AS 109 will say that the initial recognition of this loan will be at fair value. That is, if a similar loan was at market terms, in which case what would we have received? Well, if you are promising to pay back 1000 rupees after 5 years, in today's terms it will be how much? You will try to find the fair value, which is 1000 rupees after 5 years. If the market rate on similar instruments is, let us say, 10%, so this is the present value factor at the rate of 10% for the 5th year, which let's say comes to 0.6209, in which case you will show 620.9 or 621, for example, as the value of the loan, in which case your journal entry will be bank account debit 1000 you have received to loan under Ind AS 109 financial instruments will be 621. So the remaining 379, for example, will be what? Well, this will be treated as grant. So you will quantify the grant by calculating the fair value of the loan, step 1. Compare that with the issue proceeds that you have received, let us say 1000, and hence 1000 minus 621, this is probably 379, will be shown as a grant. This grant will be accounted for as per Ind AS 20. That is, if this concessional interest loan is given for the acquisition of an asset, then you can reduce this 379 from the cost of the asset or show it in the deferred grant and then amortize in the ratio of depreciation. Or if it is for the purpose of compensating for past losses, then this 379 can be taken directly to the P&L as grants linked to income. Or if it is for meeting future expenses like training expenses, for example, in which case this 379 can be deferred over the number of years when these expenses are going to be incurred. So the accounting over here will be dependent on the type of the grant as per Ind AS 20. So this is something which is, in my opinion, very, very important. Sometimes there is also a possibility that there can be a refund of a grant. So next case is refund of grant. In case, why would there be a refund? Well, that is because you received a grant and you believed that you will fulfill the conditions. However, for some reasons you were unable to fulfill the conditions, in which case the grant received has to be refunded. The amount of refund will be as decided as per the grant agreement. So from where will the refund be accounted for? The general rule is the refund will be taken out of the ledger where the grant was originally taken. So if it is an asset linked grant, the grant would have originally been taken into or reduced from the asset, in which case the refund would also be adjusted against the asset. So when you are refunding, let us say the asset will be debited originally when you received the grant. Let us say there was a 300 rupee asset and a 200 rupee grant, in which case you recorded the asset as 300 minus 200, that is net 100, assuming no depreciation for simplicity. When this grant is refunded, then the amount of refund will be added to the cost of the asset. On the other hand, if you had originally shown this grant into the deferred grant account, then at the time of refund, you will again adjust the refund from the deferred grant account. So that is deferred grant account debit to bank. In either case, if there is a difference, the difference will be going to the profit and loss account. So you will have to first find the balance in the deferred grant account and compare it with the payment. Excess, if any, will go to the profit and loss account. Same is the logic for income linked grants, where if it was an unconditional grant, it would have been taken into the P&L account, and if this grant for whatever reason has to be refunded, then you will debit the P&L. Or if it was a grant which was linked to future expenses, which was initially recorded in deferred grant and then amortized, the law is still the same. You first adjust the refund from the balance in the deferred grant, and then excess, if any, will be taken to the profit and loss account. Sometimes it might happen that the refund comes with an attached penalty, that is an excess amount over what you have even received. Then that penalty will typically go to the profit and loss account only. The last part over here involves a presentation of the grant in the balance sheet. Remember, if there is a deferred grant balance, it will be shown as a part of liabilities. If the grant is expected to materialize in the next 12 months, then as a part of current liabilities. Beyond 12 months will be non-current liabilities. In the income statement, if it is a grant linked to assets, then the grant which is amortized will be taken into other income. It will be credited to income in the P&L. It cannot be offsetted from depreciation. On the other hand, if it is a grant linked to income, then the grant which is amortized can either be shown in the other income section, or it can be reduced from the corresponding expenses. Like the training expenses may be 100 and the grant for them may be 60, then 100 minus 60, net 40 can be shown, or 100 of training expenses and 40 of other income can be shown. So this kind of gives you a general overview about grants. I hope this video has been helpful. Thanks a lot for your time. I'll see you with a new standard soon. Till then, study hard. Good luck. Goodbye. Take care.